All right, everybody. Hey, welcome to Note Nation Top 40 Tours. We get rock and rolling all across the country today, tomorrow, and for the next couple of weeks. Welcome to the virtual bus. We are honored to have you guys and gals join us to watch us either live on Zoom, on Facebook, or catch the replay out there. So wherever you call home, welcome to the virtual Note Bus. And once again, guys, we are kicking it off in the Big Apple tonight. We're going to talk about the opportunities, what's going on, the numbers behind the numbers, and why I think we are headed for economic downturn, but a financial windfall for some people who know how to leverage what they learn, and especially their actions over the next 60, 90 to 120 days to take advantage of the opportunities that are hitting the market. So as always, welcome to the webinar. Scott Carson here, excited to be here with you guys tonight. We've got a variety of different local and national investors local to New York City, and some people join us from all across the country. We have existing real estate investors. We got new investors who are looking to get in info on where the opportunities lie, things like that in the markets out there. We're going to discuss some statistics and the numbers that you probably have seen, but talk about kind of what's the step behind them. What do we see behind those as a real estate investor? Then we'll talk about the second half of 2020, what the outlook kind of details and where we think the opportunities and future opportunities lie. And we'll talk about where and when and for you guys how to get started. So once again, if you do not know me, hey, welcome. I'm Scott Carson. Been an active real estate investor since 2002. I've been in the finance, mortgage, and debt markets since 2004. It's hard to believe time flies when you're having fun. But over the last 12 years, I've purchased over $500 million in debt, residential loans, commercial loans, regentrified them, forbearance agreements. Been doing a lot of this stuff for over a decade now as I went through the Great Recession, like many of you guys and gals out there, but learned some valuable tools before it arrived so that I was able to really implement and make a lot of great changes and create a lot of win-win scenarios, not only for me. I've been teaching real estate investors how to do that as well for a decade now. I have the podcast, a very, I guess you could say, a popular podcast, over 25 million listeners across the country, called the Note Closers Show podcast. You can catch that anywhere that you listen and download your podcast, or you can also catch it at weclosenotes.com, which is our main homepage as well. But I currently invest all across the country. Have been doing that for over 10 years now. But Austin, Texas is home, and you may be wondering, why the heck am I wearing a Yankees hat and cap and jersey? I'm a big baseball fan, and literally 10 years ago, I sold everything I owned, jumped in my truck with my dog, and I spent what I thought would be the next 30 weeks traveling the country enjoying baseball. And I love baseball. I miss baseball like many people out there. Hopefully they'll get their act together in the season. But that 30 weeks actually turned into over 3.5 years of traveling the country, working with real estate investors in all markets. It was one of the best things that I could do to help me grow my business. And as we've all been facing pandemic, quarantined and home under house, I won't say house arrest, but home quarantine for most of us out there across the country. I was like, listen, I really would love to get out and see some more baseball games, but I'm not gonna be able to happen this year. So let's do it virtually. Let's get out and network and share what's going on in the markets with everybody out there and do a virtual bus tour. And we're honored to have you join us tonight, and honored hopefully that you'll take away some numbers and some things to put to work for you guys and gals immediately out there. So let's get rocking and rolling here. So what do the national numbers say, everybody? Well, they preach a lot of doom and gloom, but if you look at the numbers, you can see opportunity in those numbers. Now, what I mean by that? Well, let's talk about some of those. Numbers came out. We're at 11.1% unemployment rate in June as of last year. I haven't had the July numbers out yet, but 11.1% of everybody, that's the unemployment rate. It's kind of scary. 1 in 9 people. That means 17.8 million people are unemployed right now, for the most part. 17.8 million people unemployed. That's scary. Think about that, everybody. 52% of small businesses are expected to fail, not recover from this. Only about a third of them believe they could go 6 months without, in the current status of the country. So that number may be a lot bigger. We all know a lot of the bigger chains and retail stores are struggling. But here's the thing. 10% of Americans were already struggling to stay current before Captain Charlie showed up, okay? 10% of homeowners were already 30 days behind in their mortgage. Most people don't realize that. Now, this they've taken the opportunity like, oh my gosh, I got to get out of jail card here. I can be on a forbearance agreement. Nobody can foreclose on me. Okay, that's great for them. Not so great for the banks. We have a staggering 7.76% national mortgage delinquency rate right now. 7.76. That's the average across the country. In some places it's higher, other places it's lower. That's not even considering everything. That's just on the single family side. That's not considering commercial debt, owner finance debt, contract for deeds. Does not include any of those numbers in there. Okay. But there are 4.1 current million Americans, 4.1 million Americans currently in default. All right. So they say in default, current default, forbearance agreements default. Okay, that number may be about 30 days old, but you have to realize if we've got 17.8 million homeowners or people that are unemployed and 4.1 million homeowners currently in default, who doesn't agree with me that number is going to go up? Right here, okay? And if you think about it, we've already hit 1.6 million defaults already, obviously 3 times that, okay? But if you look back in history, this is the scary number, okay? I don't want you guys to run screaming, being upset and sad. But if you look back to 2008, it took us 18 months from the start of everything to hit that 1.6 million default number in 2008. And that number grew, so we had 15 million homeowners underwater. All right. Well, we did it in 60 days, people. Way to go. Congratulations, America. Way to overachieve. All right. That's why I think things aren't going to get better anytime soon. And that's sad. Now, how do those numbers reflect? Obviously, mortgage loan delinquencies hit record highest spike in 2 years. I mean, 2 years ago, we were doing pretty well. But the thing that I want you to look at, this article that just came out from DS News, is down here. Non-prime loans experienced the greatest annual increase in delinquencies in June, rising 21.8%. All right. Oh, that's crazy. Second highest loans with expanded prime loans, 12.2. Reperforming loans, that's what RPL stands for, experienced a 6.4 annual incline, while prime loan delinquencies rose 5.5%. So it's not just A paper, it's A to Z and double Z, all right? Everybody's hurting. We all know this. People getting laid off, people struggling. That's not difficult to understand. Now, mortgage delinquency had record surge in April. We know that. Doesn't surprise me, okay? 1.6 million in just April alone. Now, if you look at a couple things, which is important here for you guys, especially on the calls tonight about New York City, is New York City ranked 3rd in the top 100 largest metropolitan areas with a 5.4 delinquency increase. Okay? Only Miami and Las Vegas had higher. Nevada was among the states with the biggest delinquency rates, climbing 5.2 nearly. New Jersey and New York followed, rising 5.1 and 4.9% respectively. There you go. Way to go, everybody. What does that mean? That means there's opportunity out there to step in and do some good. There's a lot of opportunity. And good news or bad news, you can take it either way. It's up to you to decide which way, how the cookie crumbles, I guess you could say. Is it going to be something that you're excited about? Something you're going to be sad and upset about? And don't get me wrong, everybody has ups, peaks and valleys of this. We have good days, we have bad days. We get excited days, and other days we the heck just don't want to crawl out of bed. And I guarantee America is feeling like it's going through one hell of a Corona hangover, right? That damn Corona beer, all right? God knows this. But if you think about this on a national level, 1 out of 20 borrowers went into default, okay? That's the thing is that New York has less than the national average, which is good if you think about New York City, okay? The thing that works in borrowers' favors, if you are in default, is you've got a long ass foreclosure time frame. Now, Fannie Mae publishes the days to foreclose. The day of foreclosure takes place. The average time frame in New York State to judicial foreclosure, 1,740 days. Not quite 6 years if you need to go through judicial foreclosure. Well, and in New York City, it's even longer. All right? That's not my numbers. That comes straight from Fannie Mae. From the time it begins to the time that it ends, if everything, it gets dragged out. We all know it takes forever to foreclose in New York, New Jersey. Always has, always will be. That's why it's not quite the most tenant-friendly state if you're an investor. You got to know what's going on, especially outside of the Big Apple. Now, the thing that's going to drag things out even longer, like it did 10 years ago, is we have first and foremost a backlog of forbearance agreements. We've got 6 months that Fannie Mae is giving. They're expecting to roll a secondary wave of forbearance agreements for an additional 6 months out there. Now, why is that important? Well, that's only on the government-backed mortgages, okay? You look at the other bigger cities, Buffalo, Niagara, all right, Albany, are also hit hard. I think a little bit more so because of the fact they got lower price points. It's not nearly as expensive to live there, but also the incomes there is not as much as it is in New York. Price points are a lot cheaper in those areas, but you still have people struggling all across New York, not just New York City, but New York as a whole, okay? It's going to be a while before REOs hit the market. So with that being said, what's an REO? No, that's not a cookie that you twist and link the centers and put them back together. That's an Oreo. In real estate, in banking terms, an Oreo, other real estate owned, or REO, real estate owned, that means those are houses that the bank has taken back. They've gone through the foreclosure process and they foreclosed and taken the property back to try to sell it. All across the country, we see an increase in zombie homes where they've been foreclosed on, banks working through things, or the borrowers have just upped and moved out, expecting foreclosures. We see that happening outside of New York City than we do some more so than in New York City, all right? So if we look back at what they predicted for this year, we thought 2020 would be another great year. Existing home sales would increase by another 5%. But we look back now, existing home sales have dropped year over year. Existing home prices have gone up. Actually, they've gone down some because of things. Prices have dropped dramatically in a variety of things. We look at what the foreclosure market looked like in New York City pre-pandemic, okay? This is information pulled from Zillow right before everything kind of rolled into, okay? Potential foreclosures in New York were 763 total. Homes for sale in New York was 1,800. Recently sold was 3,700. The median list price was 895,000. It was a 5% price drop versus April of last year. And this numbers came out. This is the thing that came out in March. Well, you can see the number of defaults, as you can see here in the conventional loan. All loans on average across the board. But you got your Fannie Mae loans are roughly right at 9.69% default rate. Your conventional loans, 3.16. Your FHA's at 9.69. Your VA loans at 4.36. All loans altogether combined, 4.65. You've got an increase, obviously a decline, defaults, boom, it's kicked back up. Percentages have definitely kicked in. So that's the thing to keep in mind. We've been in this downward cycle as far as foreclosures. That number has rebounded back. We are in definitely a market. If you think about, here's another article, real estate prices fall sharply. All right, number of sales in Manhattan alone dropped 54% and the median price fell. Yes, it just fell to $1 million, the median price point. Okay, and here's a chart of that. All Manhattan prices for those in New York City. You can see it's a 50% over last year, and it was even more dramatic 60 days ago. May 4th, we were at the lowest point, roughly 32%, not 69, all right? That's not a lot, everybody, and that's taking it on a week-by-week basis there for you. Really dropped there on property rates. Let's talk about forbearance numbers continuing to retreat. Now, that's been saying they're dropping back as people are starting to maybe get a little back to work. That's great. It was down in the middle of June, 3 weeks ago. It dropped down by 57,000 and 0.1 percentage point from the previous week, okay? That's still a tremendous amount of forbearance agreements, number of people out there, especially in the government hold stuff, that's dragging out. But on other things, traditional things, hey, yeah, it's reducing because other banks are like, I can't afford to let you go. Lenders, I can't afford, we're not government backed, we're private lender, I can't afford to let you go 6 more months without paying a mortgage payment, okay? And here's the numbers you can see on the Fannie and Freddie and the FHA and the VA numbers. How the number has increased. The total all over the place there is just under 5 million loans in active forbearance plans across these three. Okay, and you see the number has increased dramatically since March 24th on this chart. Okay, but let's talk about the commercial debt. Yeah, we all know residential's taking a beating, but hey, government's gonna save us. What about commercial debt? Well, we all know commercial's gotten ugly. There's over $20 billion lost. $50 billion lost in the commercial mortgage-backed security market at the end of March. I did a whole webinar on the commercial real estate meltdown, and I encourage you to go check that out on our YouTube channel at WeCloseNotes.tv. But the fight over commercial rents get ugly with defaults wave looming. People are just shutting up the businesses. When you have national chain just stopping paying, even though they're still open, that's a difficult thing, all right? Groom glimpse of U.S. small business with 52% predicting failing. Retail, restaurants are all hit hard, okay? Big box stores have always been hit hard, okay? Virus pummels the commercial real estate market could end a long boom. We've known the long boom has been over, thank you, but this was written just 2 weeks ago. As expect to see a lot of rent signs, and those numbers will affect you depending on what aspect or what niche you're looking at, okay? Here's the thing, 1 in 5 hotel loans are in default. That's across the country. You want to pick up a hotel? Now's the time. Hotels were in a huge default rate back when? 10 years ago. We saw a lot of hotel paper hit in the market that we could pick up relatively cheap. Okay? 1 in 5 hotel loans is in default. And that's not just small mom and pop. That's also some big ass things. 1 in 10 retail loans are in default. Okay? Retail space of a loan are in 10% default. Office vacancy is not only default, but it's set to increase to 19.4% vacancy rate across the country. 20% of the offices are vacant as of roughly about right now, and it's going to get worse before the year is done. All right? Expect vacancy rates for retail and restaurant space to stay at 15% or more. They're only expecting about 1 out of 3 restaurants really to come back. Now, they talk about, new chefs will appear to come in. Yes, but that doesn't mean anything that's going to help anything. I think you're going to see the wave of a lot of food trucks. Food trucks across the country, I think is what we're going to see, a big chunk of it. Obviously, Uber Eats, and you see a lot of things going on with that and them trying to take over another company. I remember who they're trying to take over. But DoorDash and all those, we're going to be in get it to go, or fast food economy. That's going to help our health in any form or fashion, okay? We're expecting rents on commercial space to fall an additional 10.5% by year end. And that's one of the things that a lot of landlords are doing. They're having to drop rent. They're having to negotiate. We see that happening in Austin. We see that happening across the country. People aren't working from home, and there's going to be a lot of companies that aren't renewing their office space because, I don't have to do it now. I can have my staff work from home. We can jump on Zoom. We can do a tele webinar. They're going to work more effective. We can go to 4-day work weeks versus 5. I mean, when you have Google giving in California, giving their employees $1,000 to work from home, to go buy furniture to get ready for it, that should tell you a little something. It's the same thing in New York. People don't want to be out. People would rather work remotely than work around a big population. And you've seen that in New York. Declines in rents are expected to increase in 2021. People are leaving the city. They're moving to the Connecticut. They're moving to the New Jersey. They're moving into the New York countryside to get away from the craziness. Okay. Now, talk about commercial defaults. This is nothing new. We've seen a lot of these larger hotels struggling for the last couple of years. Here's this one here. A report found at least 21 commercial mortgage-backed securities mortgages backed by New York hotels are watch listed for potential difficulties, they say. Now, that's a bunch of BS because they're already been in difficult. Since 2018, here you go, a $260 million loan on a 1,300-room row hotel near Times Square has been in default since 2018. And Colony Credit recently tapped a brokerage firm to sell it for as little as $50 million. What? That's less than 20 cents of the unpaid balance. What? That's crazy, everybody. That's like, what, 18 cents on the dollar to get it moved? How big a bloodbath are they taking? But that's when you got $50 million. You can own yourself a 1,300 room hotel there, okay? Now, big deals like this are going to get gobbled up by a lot of funds. They're going to get gobbled up by other things. But honestly, it has not been gobbled up yet because they think the market's still going to go further south. That's pretty sad if a $260 million loan can't be picked up for 20 cents of the dollar. A lot smarter people know something than I do, okay? Figure this out, everybody. There's a lot of stuff going on. It's gonna be crazy. You're gonna see a lot more stuff like this in the near future. So where are the opportunities? Well, they're in a lot of places. Foreclosures, REOs? Not really. If you want to be the next REO millionaire and flop this house or be on AMCD as buyer of REOs that you fix up, you're going to have to wait a while. It's going to take, especially in New York, a long time before foreclosures and REOs hit the market for the most part. I think you've known that for a while. Fix and flips, same thing. If you want to buy a deal, it's going to take a while, and it may just get bought up and modified, and the people buying the debt may just keep the property or keep the borrower in place and work out a modification. If I could pick up a note at 22 cents of what's owed, considering that the value is probably pretty close to that loan amount, especially in commercial loans, everybody, 100% usually doesn't get financed. It's usually at 75, 70 cents of the dollar. Somebody's got to bring some money to the table. A $260 million loan does not represent 100% loan to value. Same thing on the residential space. So we're going to see a lot of notes. We're going to see it as cheap as like 5 cents of the dollar, like we saw years ago, picking up properties for just a song and a dime. No. Rentals? It depends on how friendly the city and the state are. I don't think rentals are a good play in a long eviction state. If you got to foreclose and then evict the tenants, it's not a fun thing to do. It's a long time to tie your money up before you see anything. Now, could you negotiate with the homeowners, take over subject to, or like I know some of my buddies, they just stopped paying their mortgage and just collecting the rents, okay? All right, whatever your flavor is, that's up to you. But really, real opportunities out there lie for those that are in the debt game, that are in the paper game. And honestly, everybody, whether you're a real estate investor or not, you're all in the debt game. If you've got a mortgage, a car payment, student loans, credit card debt, medical office, whatever it might be, if anything you've got going on, IOU with your Uncle Lou, you're in the debt game. You just got money flowing out the wrong way. You want money flowing in. That's why the banks are the biggest out there. You also don't hear a lot about banks, but there's a lot of banks that have some bad paper on their books, not just that one with that one hotel. And that is where I believe we're going to see another tsunami of debt hit. This banks have been kicking the can down the road. Oh, thank you, Jenny. Thank you, Fannie, Freddie. Thank you for delaying these things, okay? You're going to start seeing residential notes, non-performing residential notes hitting the market close to the fourth quarter. Well, it's July, everybody. What's that? That's like 60 to 90 days out. That's not that far away. Commercial notes. We're already seeing commercial paper hit the markets. Already, when these big companies are going out of business, you know what's going to happen? You're going to see malls turn into ghost towns. You're going to see big box stores sitting vacant. Unless somebody gets interested in coming in and regentrifying, restabilizing this specific asset class, it's going to be a lot of opportunity out there. You're going to especially see on the commercial side, the sub 1 million. I know in New York City, that's a figment of your imagination, but you're going to see a lot of opportunities from banks, not only banks in New York, but banks across the country. On that commercial debt that's below $1 million is where they're going to probably be looking to move in a lot of things. So that's other banks in trouble. Now, there's a ranking system, a company called Bauer Financial that we work with. They provide quarterly reviews of every bank, FDIC bank out there. They're not pulling credit. They can pull credit unions. We don't do that. We spend our time on the banks. We don't waste our time on the credit unions because we want to know where most of the paper is at, residential, commercial, okay? Now they came out with a report in June, just recently, and there are more than 74 banks that lend in New York State. We know that. There's a lot that lend in New York State. But for Bauer Financial reports, what I did is I pulled the list, narrowed it down to banks with more than 5 branches with their home offices in New York State. And out of the 1,500 or 2,000 banks, 74 of them have their corporate offices, the main offices in New York State. Now, why is that important? Well, if you look at their 90-plus accrual loans combined, they have over 3.8 billion in loans that are 90-plus days past dues. And that's basically a $51 million average per banking institution going to run across all 74. Okay? And a lot of these banks are ranked as 4-star, 5-star. Oh, they're doing so well this quarter. But what happens in the next 60 to 90 days when the next report comes out in September? Especially first year. You're going to see a lot of banks be downgraded because of the stuff they have in their books. And I looked over quarter to quarter, and how can you tell when a bank is in trouble? Is a bank wants to be making loans, okay? They don't want to have a lot of reserves in. But for banks to sell a lot of their debt off, they have to start accumulating reserves to offset those losses. And we saw an increase in reserves across the board this quarter. Everybody's starting to sock away a little bit of money, or more than a little bit, because they know bad times are coming, all right? So you figure about this, that on average across the 74 banks, when I looked at the numbers, 5% of each bank's loans are at least 90 days past due. That's crazy. That makes up a lot of 3.8 billion. I don't need all of that. I need 1%, or I need half of 1% to make me happy. Right? There's basically 1.4 billion in single-family residential loans in default. The rest are commercial. There's a couple, two really big guys that stood out. Sterling National Bank had over $100 million in default on the residential and commercial side. And so that was just commercial. Sorry, 100 million was like 101 plus million is just on the residential side. And then manufacturer and trade interest bank, M&T Bank, had 820 million in distressed debt. That's not everybody. That's just in 5 minutes from our report. Now, if I take in consideration that those are just banks that have their offices, if I were to spend some time and dive in, take a look at everybody that does lend in New York State, that number goes through the roof. That number is ridiculous. All right. If you're enjoying this, you're maybe a little scared, type in the chat roll, scared. If you're excited, say happy, scared or happy in the chat roll, within the Q&A, or watch us on the live stream. Do that for me, okay? Because that's scary. That is scary. Like Spidey senses going off from 10 years ago and saying, okay, are we going to see a repeat? Yeah, we're going to see a repeat. But why get into the distressed debt side? Why should you look at getting into being a note investor, or looking at buying debt versus the other aspects of things? Well, because for a couple of reasons. One, we're a lot closer to the source in the note game. All right. You can start buying distressed debt now or in the next 60 days versus waiting a year for deals to hit the market. And we all know the market was overpriced to begin with. We knew we couldn't keep going things up. And look at the price reductions across the board. Look at the contracts that have been canceled. Okay. You can start buying debt. You can start getting involved now versus waiting around for that shoe to drop, or after it goes to foreclosure. And yes, we know each state's different, but we all know things aren't going to be the same for a while. You can purchase debt at significant discounts depending on the location, the foreclosure time frame, values, condition. You know, you don't have to have a huge amount of capital to be buying debt, depending on the state that you're in. Obviously, New York City, with the average being $1 million. Okay, you're going to need some cash there. But there's a lot of other states out there that have distressed debt as well. Other areas in New York. I mean, heck, you could pick up properties in Buffalo, Niagara, Syracuse for really cheap. Syracuse is one of the most struggling markets in New York. The big thing about buying that debt is you're in the banker's seat. If you're buying a debt at a big discount and you're controlling the assets, he who controls the equity controls the asset. And if you're in a first lien position, that's all we would recommend buying and investing in. You're controlling that asset and picking assets up at huge discounts, 30, 40, 50, 60, 70% off of as is value. That gives you a lot of flexibility as the bank to be able to step in and do some good. Keep the borrowers in the property. Hey, I know you're 6 months behind on your mortgage payment. You got laid off. Are you back to work? Great. Can you start making your existing payment? Great. Do you got a little bit extra? Great. I know you don't have 6 months. But if you got a little bit extra, it goes a long way in helping us make this a win-win. And that's one of the beautiful things. There's so many different strategies in the distressed note game. Loan reinstatements, modifications, short sales if they want to leave, doing a short payoff sometimes. Hey, if you buy the debt cheap enough, you can offer up the borrower, hey, you want to just buy the asset from me and I'll forgive a lot of the debt? I bought it at 5, I'll give it to you at 50. What do you say? Of course, you can foreclose. Of course, if it's an asset you're looking at, you can flip it. You can wholesale that out to other investors out there if it makes sense, all right? Or worst case, you offer the borrowers deed in lieu or cash for keys, all right? There's a whole lot of different strategies that you could do to make money in the debt game versus just waiting to foreclose and buy and sell. The problem with most people chasing REOs and foreclosures is that's all they know. And that's the bottom, that's the end of the line. All right, when it comes to the distressed real estate. Yes, you fight over the foreclosure auction. Yes, you're fighting the foreclosure list. Yes, you're mailing out postcards and letters and spending thousands of dollars each month to try to get a borrower to call you back for one deal. Now, that's the beautiful thing is I don't want that. I don't want the house. I actually would rather prefer to take over the note and turn it into cash flowing, performing note after a while, where I got mailbox money. I can do this business from anywhere, okay? If you want to, you can then take over the property and do what you want. Let the borrower walk away if you want. Keep it as a rental at that point. But you never have to fight the other 50, 60, 100 investors in your zip code trying to find deals. We see deals all the time 6 to 12 months before they would ever hit the foreclosure auctions, ever hit the MLS. And that's the beauty. We're going to see that again, everybody. You're going to see that again. So what are some other advantages of note investing? I said this before, no direct mail costs. If you're a new real estate investor and you're going to your local REIA club and they're talking about yellow letters and door knockers and bandit signs and all that crap, just go ahead and put that credit card in your pocket and walk on out. All right. We don't do direct mail, postcards, letters, bandit signs. We don't spend thousands or $5,000 a month to get a deal and get just one deal from one borrower. That's the old way of doing business as a banker. That's what you are when you're buying debt. All you really need is having emails, LinkedIn, and then you have a phone to dial for dollars. You don't even have to have a phone if you don't want to. But if you've got an email address and you can jump on LinkedIn and start tracking down special asset managers, secondary marketing managers, all those people to handle that. I actually had 3 bankers reach out to me today, ask me what I was looking at buying. And that's the beauty. One of those sources leads to regular deal flow every month, every quarter, every year. Not, hey, I sent out 5,000 postcards and I had 4 people call me back and I got maybe 1 lead. No, that's not the case. We don't sit there and fight over scraps. We get plenty of deal flow from the banks. They would rather get it off their books at a discount and move on. And that's the beauty of it, is we can cherry pick the deals that we see for our own portfolio. If it doesn't fit what I want, I don't do it. If it doesn't fit for somebody that I know, I don't do it. We move on. Next. But if you do want to put some money together, you want to bring some investors in with it, you can get some bulk deals and get even better pricing because you take the good, the bad, and the ugly with it. And how do you make money in the good, the bad, the ugly? Well, on the good deals in that portfolio, you sell those off, you try to make your investment back. You make the majority of profit, though, in the middle 50%. You may lose a little bit in the final 25%, but there's always somebody out there looking for those handyman specials. And you can do this residential commercial deals from the banks because they've all got it on their books, and they're all looking to move it right now, all right? If you don't have the money yourself, that's fine. Raise the capital from other investors to fund the purchases. There's a lot of money and investors sitting out there really dying to put their hard-earned assets to work, okay? If you think about this, that in 2010, 2 years after the start of the Great Recession, we had 15 million homeowners underwater. 6 months ago, we still had 3, all right? There's still a tremendous amount of opportunity, and we're hitting those numbers. Remember, it took 18 months to get to 1.6. You've already exceeded that in the first 6 months. Now, are there investors out there? Yes, there, especially in New York City. Oh my gosh, you guys have so many investment opportunities, so many investors up there that have money because it's an expensive place to live. Now, across the country, there's $9 trillion in retirement funds out there waiting to be invested. $9 trillion in retirement funds. In just New York City alone, there's just under 210,000 real estate investors. 210,000 investors. I'm sorry, my apology. Let me rephrase that. 210,000 people that have an IRA account in New York City. Out of that number, just under half have at least 150 grand or more in their accounts. 150 grand, you could buy some pretty decent assets. It doesn't take you long to put $1 million together. Whether you put in a fund or you're having funding individual assets, there's some things you want to do. You need to speak to attorneys, make sure you're doing it properly. We won't get into that tonight. But 140,000 people in New York City have at least 150 grand or more in their accounts, okay? Now, there are 118,000 real estate investors in New York City. It's true, they classify themselves as real estate investors. That's crazy, all right? That's a lot of people that have money and looking to put deals together. The question is, do you want to be the banker or the borrower? You don't want to be the person trying to go borrow money from a bank right now. You want to borrow money and buy the assets from the bank, but borrow the money from private investors. A lot of opportunities to do that. One of the things you can learn how to do, it's easier than expected. It's easier than you would think it is to become the bank, everybody. And the bank, I'll tell you this, always wins. The bank, no matter what happens right now, it doesn't matter how great a person the borrower's out there, if they can't come to some sort of situation, get back to work doing, the bank is going to win. Now, the bank is going to win even if there's a landlord in place, an owner who's renting it out. You know what? Yeah, the tenant may be struggling, which in turn leads to the landlord struggling, okay? Which in turn leads to the bank struggling to pay that many loans. You as private investors can come in, buy this debt, become the bank, and have the same rights to the bank to foreclose, modify, do whatever you want. But do it at a fraction because you're picking up as a distressed discount. You're buying, hey baby, America is on clearance. And you can go and pick through the clearance rack and often find some pretty sweet deal. So how do you tap into this tsunami, okay? I've been teaching investors for note investing since 2010. As I said, I bought over $500 million. I've helped thousands of investors purchase their first non-performing note. It's one of the things I do. No, it is not difficult. There's investors out there, educators, you could say, that talk way above people's heads. This is a pretty simple business. You just got to have a little bit of a different mindset. And you can buy residential or commercial notes. Even if you have no background in it, there are things that you can do, and everybody's got to start off somewhere, everybody. The most sophisticated banker was a teller or opened a checking account when they got started years ago. And if you're looking for cash flow, great. If you're looking for asset growth, asset accumulation, great. Fine. Whichever one floats your boat and makes you happy. Now's the time to learn this, to put the strategy to work. I'm not talking about, oh, add it as another tool to your tool belt. Screw that. Give me a hammer, get rid of the rest. Actually, in this case, throw the hammer away because the pen is actually mightier than the hammer these days. And too many investors are out there trying to do, old-time real estate investing. You got to be a banker. It's a 21st century, and Scotty here is here to beam me up, everybody. You can buy one-offs, or you can buy in bulk. Trade from $25,000 to $5 million, I think, that we've closed on. We've helped investors. I mean, the cheapest note I ever bought was $7, and I flipped it for $5,000. Okay. Our average trades when we're buying assets in New York are usually cheaper because it is a longer foreclosure state, but I buy in other states for the most part. You can buy them a lot better, about fewer price. No, you don't need to have good credit. So if you're a distressed borrower yourself, or you're a struggling business owner, don't worry. The banks don't give a rat's ass about your credit if you're buying a debt. They don't care where the money's coming from, so I don't care if you've got a wicked jump shot or you're slinging some crack rock, okay? If you can talk to people around you. I mean, literally, you could throw a rock and probably hit 3 investors in New York. You can do that just about anywhere across the country, okay? No credit needed, or you don't have to have your own funds. So I don't want you thinking, well, I gotta have my not. Well, that's one of the great things we show people how to do. You can get started if you've got email, a LinkedIn profile, a free account, and a phone we talk about. Those are 3 things. Yes, there's things you can build on there. Yes, you're gonna need some money, a little bit of marketing, but honestly, that's what I started with 12 years ago when I was going through foreclosure, when I was getting divorced, where I had to get rid of my last 2 rehab properties and write checks to closing table. I started with email, LinkedIn, and a phone. That's all you need to get started. Yes, you can add things, but honestly, I'm the KISS method. Keep it simple, silly. You've got the ability to have an email that you can send an email from, LinkedIn, a free account, and set up a complete profile, and dial for dollars. Not afraid of the phones? Great. Afraid of the phones? We'll spend more time on LinkedIn. But whatever your focus is, there are opportunities out there in the debt space right now. Single family homes, mobile homes, duplexes, triplexes, fourplexes, apartment complexes. There's a big, big opportunity in the smaller 100-unit or less apartments. Everybody and their dog wants anything over. And the apartment complex is the most overpriced asset class that has been out there for the last 3 to 5 years. But many people overpaid for it. So when the market goes south and the tenants stop paying, they start to default. The values go down in the market. The bank wants to see you at an 80, 70% LTV. If you fall below that, they're going to ask you to bring some capital to the table. And a lot of these investors don't have that capital when they get a capital call from the bank, okay? There are a lot of great things. Hotels, we talked about this. I got a buddy that's buying a 70-unit or 60-unit hotel and converting it to a 44-unit apartment complex. Hello? Brilliant. Retail, if you want to do that, you have an office space. You want to create your own WeWork spot, your own executive space. Great. Self-storage, you want to take a empty Walmart or empty big box and turn it into your own climate-controlled self-storage in it? By all means, you can. All right. There's a lot of distressed self-storage units out there too. Mobile home parks may not be big in New York City, but there's a lot of call and need for affordable housing all across the country. Texas, Florida, Alabama, Louisiana, Ohio. There's a lot of opportunities in that. There's deals in every and all asset classes, everybody. I don't care what it is. The idea here is that when you're looking at a deal, you want to be a little empathetic with the borrower. And if you can buy it at the right price, you create a win-win scenario for the borrower. And one of the stories that always comes to mind is this story in South Beloit, Illinois. And this borrower had lived in this property for 18 years, raised their 3 kids. She was living it, struggling to stay at work. Her husband was sick, had a heart attack, been laid off from work. This goes back to 10 years ago. They took out a loan when the market was going up to pull a little bit of equity out for their kids and stuff like that. And then what happened? The market crashed. I picked this note up really cheap. Borrower been trying to do a loan mod for 4 years. 4 years been trying to do a loan mod, and the loan had been sold 4 times until I bought it. When I saw the numbers and what I was paying for that was literally less than 33% of market value. I was paying like 12 grand for the note. It was worth maybe 60. She had a loan for 60. It was worth about 33, 35. My bad, I got the numbers there. Anyway, I negotiated a loan mod with her, keep her in the house, dropped her interest rate to 0. She'll have the house paid off, or just did pay off the house in 7 years versus 33 years. And they cried at the closing table when they met with my attorneys and we signed the agreement. I'm making good money on the deal. They brought 5 grand to the table in payments and a little bit extra in the front end. Hey, perfect. And then over the next 7 years, we've made plenty of money on the deal. It was a true win-win scenario, and that's what I want to do. I love stories like that. That's how you really do good in this world, is that we need more good stories like that. We need people that are staying and people that are willing to come in, hey, take over some of the bank's nightmares and buy it at a price that it's not a nightmare, but a dream deal that you can knock out of the park. You can do it big or small, doesn't matter. If you want to start off small, like our buddy from Elkhart City, Gene here. Gene was a real estate investor just buying Elkhart, which is another part of Indiana. Gene came to us, got started, dabbled a little bit in investing. Fast forward a couple of years now, he's closed on a couple hundred deals, has a fund now. He's put together $13 million in the market. Started doing it with one deal. He was a hotshot guy. You know what a hotshot guy is? The guy that's got a truck that hauls something across the state and back. Now he's just a full-time note investor making millions of dollars. Our next, one of our most successful lady students is Laura Blanc. She's closed on about 100 deals, working on a portfolio of 148 right now. I think a $4 million purchase, but been a real estate investor, wholesaler, fix and flipper, got rid of all that stuff, been focused on note investing the last couple of years, doing a great job. Just bought her dream house and moved from Wimberley, Texas, home to Maryland on a house that she's wanted since she was a little kid. And congrats to her. Raising two boys who graduated, doing things as well out there. Keith Collins. Keith in Ohio, Mason, Ohio, if I believe correctly. Longtime real estate investor, been in city government, up that neck of the woods. I think he was the mayor for a while. But he sent me a message the other day that I was really proud of. He goes, Scott, what we've learned from you, we've made over $1 million in the last 12 months. But the strategies that they learned from us and how we taught them to find deals, how to raise capital to get done, and the different exit strategies, him and his wife have made over $1 million. His words, not mine. Who doesn't want to do that when they're getting a little bit of age? Who doesn't want to have that? He's not going to retire. He could retire if he wanted to, but Keith loves to work. All these people so far love to work. Really proud of is one of our newest students, Rafael Herta, out of San Diego, self-employed entrepreneur with a car detailing business that is out of business now, basically. Kaput, nothing going on in San Diego. He started learning. He came in and took our classes and learned how to do what we do. Bought 5 notes in his first 30 days. Is selling 3 of them. He got two of them reperforming. The other 3 he's selling and making a profit on it to other investors because he bought them at the right price. I could go on and on with case studies after case studies of people that we have helped to do some amazing things all across the country. And that's one of the things I'm most proud of, is that we are no nonsense. We give a lot of education. There's an opportunity for anybody, no matter what your experience or background, age, ethnicity, race. I don't give a rat's ass. As long as you can learn and apply what you learn, you can do this business. So how do you get started? How do you learn? Well, we've got a very special one-day live stream class that we teach online. It's called Note Weekend. We do this usually about one Saturday a month. 9 a.m. Central to about 2, 3 o'clock in the afternoon. It's meant to be the kind of Cliff Notes version of the note investing. You're not going to learn everything about note investing in one day, let alone a 3-day workshop, but this is a really great way to dip your toe in the water, as our students have said. Great way to kind of feel, hey, this is something I think I can do. I don't want you investing $500 or $1,000 or $3,000 if it's not something you're going to put your mind to and work to. We've had too many students do that. I think across the world, I think we've all signed up for classes or programs that are take advantage of it. That's not what I want. I like working with people that are wanting to make a difference, not only in their lives, but in the lives of others out there. A one-day online note training basic with just yours truly. It's live. You can ask questions, no pitches. We live stream it on Saturday. We restream it on Sunday. Yes, the replays are included, everybody. So if you got to step out and spend time with your family because you're quarantined at home, you can catch the replays, okay? As we call it, the Cliff Notes of note investing. It comes with an 18-page manual, a 20-page manual now. Normally $99. We make it very affordable at $49 for you guys to be able to dive in and take advantage of that. Noteweekend.com, if you go to that website, we'll even list basically kind of the tentative schedule where you can see what we're kind of covering. The outline helps. Like I said, everybody, the next one is July 25th. That's a Saturday. The one after that is August 29th, which is also a Saturday. Basically 1 month apart. People from there will then either start diving and learning, or they'll go the route of sign up for one of our other classes. We don't do a heavy pitch. My goal here is to help America understand the note business. And I have a goal to help 10,000 new real estate investors dive into the note business in the next 6 to 12 months. And I would love for all of you to be a part of that. So one day, like I said, one-day class, 9 a.m. to 3 p.m. My biggest goal is that we are going to start seeing so many deals, not only hit our books and our table, our desk, that we need people that are going to be able to take deals down because there's a lot to hit, okay? So what do we cover at the Note Weekend? How and where to find the notes. I'll show you exactly how we build lists from the websites to dive into. We'll talk about how to fund these deals with other people's money, how to find investors in your neck of the woods, how we raise capital legally from investors all across the country for our deals. We'll talk about the different exit strategies, how to actually make money in the note business, not just how to find them, how to fund them, but how to actually make some money. That's what's important, right? If you've been laid off or you're struggling, hey, let's make you some money without having to put a lot of money out of your pocket to get rock and rolling. We'll talk about the different vendors. We'll introduce you to the different team members that you'll need. And what's great about the note business is most of your vendors and partners in real estate are going to get paid when you close. All right? And there's ways to structure your deals that your expenses are covered when you get funding from other places. We'll talk about some of the different loan trading platforms you can pick up notes right now to start looking at if you don't want to call banks. And we'll cover a lot of stuff. You can see the actual itinerary section by section, minute by minute, 30-minute chunks on noteweekend.com. And it says 9 to 5, it may be 9 to 3, 9 to 2, depends on how many questions that you guys ask. And I'm always open to questions to make just things. Like I said, if you go to noteweekend.com, you see the normal price is $99. We've dropped it down to $49, cut it half off because of everything going on in the economy. Hey, $49 is a steal for you guys out there as well. And that's what the price is for the next 2 months. So like I said, guys, love for you guys to be there July 25th, the Cliff Notes version of note investing. You can go to noteweekend.com. I'll type that in the chat roll for you so you can click on there. I would love to open it up for questions, comments, concerns from any of you guys out there in the chat roll for me. Or, yeah, if you want to send it to me in the chat roll, it's fine. That's the link that'll take you directly to. Also, if you log off, it should direct you straight to the website as well for everybody. But questions, comments, noteweekend.com is where we're at, everybody. I'm glad you guys were here. Hopefully, didn't answer the numbers we went through, the markets we went through. Here's the thing. If you like a specific asset class, you just got to find a lender that is lending on an asset class. And some of the things that we discuss, hey, these lenders lend on this. Hey, you want to find a lender that's doing some mobile homes? Great. Here's where you go to, and then call them and see what they got. And then just follow up, follow up, follow up. It's one of the easiest business models that you can put in place to make some things happen for you guys. So any questions, comments, concerns before I let you guys go here after being a part of our Note Nation tour? I'm going to be a big shout out to everybody, James, Barry, Joe, Sander, Wayne, everybody else that's been on throughout the weekend, or actually throughout the day. Those that have watched on Facebook as well, you'll see some comments on there, some new and familiar faces. Always honored to have you guys here, and always honored to spend some time with you on an evening. So if there's not any questions, comments, or concerns, everybody, we'll let you guys go and go back on your merry way. So again, check it out, noteweekend.com. Love to have you be a part of it. As people being a part of it have always said, they walk away with a lot of knowledge, a lot of information that they can apply. None of this blow smoke up your tail. I'm going to show you exactly how to get it done and get it done well. All right. Thank you, guys. Have a great evening. And don't be afraid if you're investing in other cities. Check out the Note Nation Tour website, notenationtop40.com, the other cities that we're focusing on, and register as we type through those markets. I have doing LA in an hour, and different numbers, different economies of scale, and everything like that out there here in the next 60 minutes. So have a great evening, and we'll see y'all later. Bye.